Howdy, Gabe. Howdy, valued listeners and watchers. We got a special episode for you this week. You'll notice there's a guest on the show. Jason, why don't you wave your hand, introduce yourself, tell us a little bit about who you are.
Robinson, Gabriel, thank you for having me on the show. I really appreciate it. My name is Jason Parker. I'm a loan officer in Phoenix, Arizona. My background's a little bit unique, being a loan officer, in that my core training and professional background actually is a certified financial planner. I did that for the better part of 20 years. Most of the advice that I did and when I was an advisor was more in the call center type environment. But I did some face-to-face advice as well. And then, as I mentioned, I've been a certified financial planner since 2009. Really got into the academic side of the industry, being a young advisor, trying to overcompensate a little bit, being young, by trying to know everything and get all the letters after my name. So I went down that route. And then it was a year ago that, I just got to a point with my advice career that I just wanted to expand. I'd been doing what I'd been doing for a long time, really loved it, loved working with clients. But I knew that there was, a little bit more out there and I wanted to really make a difference. And I felt that, the best difference I could make is actually in the reverse mortgage space as a financial planner.
I love the story so much. And the reason that I invited you on specifically, Jason, is that I too have read some of the literature around reverse mortgages, around how important home equity is as a piece on the balance sheet of most retirees who are trying to make the income picture work. And you're the only vendor that, in my experience, reached out proactively with educational first materials that said, hey, look, I know reverse mortgages, you may or may not be using them, but I'm a certified financial planner. I care about this. I've served clients before. I've sat in your shoes, and here's some educational stuff. So you've stuck in my mind for that end. I think we're just going to dive right in. We got like a zillion questions to cover with you. So I'm going to go right into it.
Yeah.
First question, reverse mortgage. What is that? And corollary, there's a little bit of a sleazy brand history behind them. Why is that? What happened?
That's a lot of people's first question. And I think that's the kind of fundamental thing that a lot of people have to get past before they really start to open their mind and they can really digest what it actually is. Just to piggyback a little bit more on, in this, segues into this answer, what really was the catalyst for me leaving, a very comfortable, salaried advisor role, to do something, to kind of really branch out on my own, doing something I'd never done before, had to do with clients and hearing from clients. And it was especially after COVID, I noticed more and more people, were transitioning from, hey, I want to leave as much as I can to the kids to, I want to bounce my last check. I want to go out of my house toes up. I want to live it up. We've been locked down for a year, and there were more. You just got that theme more. People just wanted to actually spend their money a little bit more. 10 plus years of a call center advice environment, I just didn't hear a lot of reverse mortgage conversations going on at all, ever. And even me personally, I only brought it up a handful of times because the education wasn't there, even for advisors. It's just not out there, even in the certified financial planner curriculum. It just doesn't go that deep. And so, then the other thing was that, so more and more clients, again, in that last year after COVID, when I was an advisor, were asking about reverse mortgages. But when they would do it, and this was, it kind of tipped me off that, hey, there is an opportunity here, but there's also a major issue related to, like you mentioned, the stigma related to these things. Because when clients would ask about them, they would whisper. You'd be having this great conversation, and then all of a sudden it's like, I probably shouldn't even ask about this. They qualify the question, beforehand, and they would just get to a whisper. Do you know anything about reverse mortgages? Are they good? That sort of a thing.
Yeah. Can we talk about
but
it?
People would whisper.
Is that allowed?
Yeah, right. Yeah. It's like, and it's like, but there's this stigma, right? There's a stigma attached to reverse mortgages that, hey, these are for poor people, or, these are, a loan of last resort, or, hey, if you're down and out, you do a reverse mortgage. But when you really peel back the onion and you look at it, you can't do a reverse mortgage unless you have home equity, right? And you probably don't have home equity unless you had some sort of income to buy the house to begin with, right? And leverage as well. So the reality is that they're not for poor people at all. But to get more, to get right into your question, I would say, to kind of back up even a little bit, so the reverse mortgage was passed as a government insured loan in 1987, and it actually started as a pilot program the first couple of years. So the first loan was 1988, and that's important because when you put it into context, and again, trying to figure out, and that's what I've been doing the last year, is really researching why, to answer that same question. And what I found is, that the youngest person eligible for a reverse mortgage today, which would be 62 years old, would have been 28 years old when it came out. And then you think about, how many 28-year-olds today are, know what's going on with Medicare savings accounts and, other things that are done. They just don't, right? A lot of these people, they're early, mid 80s had already bought their homes. They'd already, had this Depression era mindset because their parents, taught them very well not to trust banks because, they went through the Great Depression and they saw what happened with people losing homes before FHA was created in 1934. So a lot of it just stems from that. And then, like, as I mentioned, the first even 10 years of the program, so even into like the mid to late 90s, there weren't very many loans being generated nationwide. I mean, we're talking like less than 10,000 a year, just a couple thousand. So, I mean, really, what's the real sample size here? I mean, nobody actually knew how it really worked. And then big banks got into it, and they were about half the market. And then in the reverse mortgage actually started to get traction up until 2008. We started to see over 100,000 originations, 110, I think up to close to 120,000 around then. And then there was a precipitous drop off after that because Bank of America and Wells Fargo, the two biggest lenders, they left the market. And they left the market. It wasn't because of the product itself. It had nothing to do with the product itself. It actually had to do with reputational risk. Because what had happened in 2008 is that there were about 100,000 foreclosures of people that had reverse mortgages. And so this is where, not to get controversial here, but I liken it a lot to COVID, where it's like when you think about these foreclosures, the foreclosure wasn't because of the reverse mortgage. It was they happened to have a reverse mortgage and they didn't pay their property taxes. That's what most people do. And then we can, talk a little bit about why that happened. And it's maybe not the borrower's fault. Maybe there was a predatory lender. Maybe they didn't get the education. Maybe they didn't know they had to do that. Or, maybe they didn't have the money. Since then, FHA has made, considerable changes to safeguard all of that. So that can't happen anymore anyway. But what had happened is that now all of a sudden you have, think about it, just logically, somebody doesn't pay their property taxes. They get, and then, the county the lien holder is actually the lender itself, right? Not the county. And so if the county needs to force somebody to pay taxes, they're going to tell the lender, hey, you need to foreclose on them so we can get our money. Right. And so technically, yes, it was a foreclosure, and yes, they had a reverse mortgage, but it wasn't because of the reverse mortgage, because you have to pay your property taxes even if you have your home paid off, right? And so it was almost like, COVID, let's say you die in an auto accident and you have COVID. Yes, maybe, is it a COVID death? I guess technically yes. Was it because of COVID? No. There was, and so that actually fed a lot of that stigma. And then from there, again, it was still relatively new. There weren't a lot of, there wasn't a lot of other experience out there. And then it just got, then it was buried with TARP, and, none of the, the FHA updates ever got, really put out well, and just buried in the news of everything else. And it just, then it was clickbait articles about, these using these statistics, warning people away from these things. So that's part of it. And then, the other part of it that I've actually heard from clients, and I wouldn't have even really thought, I actually thought it was more of a positive. But I've heard from clients that they think that, even just how they're advertised, right? How they're marketed and who they're marketed by, it may not be the best, or maybe it hasn't been the best representation of the product. And that, the fact that it's, advertised next to Rosalind Gold and, all these other, lotions and potions on the news channels, these infomercials almost about them, it just makes it come off as even gimmick, even more gimmicky. And so then, the walls are even further up.
For someone who has no introduction, what's a reverse mortgage?
Technically, it's no different than any other mortgage in the sense that it's just a lien on your property, right? That's what a mortgage is. The difference in what's reverse about it is, instead of you borrowing money and paying the bank every month, you do a reverse mortgage, you get a lien on your home, and based on the property value, based on interest rates, the bank is actually going to loan you cash or loan you access to cash. If you didn't need the cash, you could set it up as a line of credit. And so, a reverse mortgage, that is that. A better way to really explain it and understand it is actually by using the term that FHA coined when they mandated this, and it's the HECM. It's pronounced HECM, so you have to get used to saying that a little bit. I think the first time anybody says it's kind of like HECM, it doesn't have the best flow either. But it's home equity conversion mortgage, and that's simply what it is. You're simply converting home equity that's otherwise illiquid into something that's liquid. That's it. It's literally a conversion tool. Or other than using a reverse mortgage, the only other way that somebody can access home equity, which tends to be one of people's largest assets. There's over $10 trillion of senior wealth right now, that would be able to be used by seniors that isn't being used because it's just sitting in brick and mortar. Other than selling the house, right, which a lot of people plan to do. That's what they think. Hey, we're going to kind of ride this house out as long as we can, then we're going to sell it and we're going to downsize. We also know from research that people actually don't really downsize. They kind of right size or they kind of even size. Because especially with property values going up, there is just, you'd have to really downsize a lot from what you're used to actually be able to keep some of that net equity out. Or you can do what a lot of people do just by knee-jerk reaction and default, and because they trust banks just in general, is a home equity line of credit, right? Or take some other kind of lien. The issue with that, though, especially in retirement, as you both know, is that that's going to compromise your cash flow, because now the next month you have a payment that's due. So it's kind of like, taking from Peter, to pay Paul every month. And then you have, interest rate considerations, and, there's other issues as well with the HELOC, which doesn't make it a longer term, really viable long-term tool for a retiree. So the reverse mortgage is, again, government insured loan that allows a borrower to go to a bank and, understanding that, hey, it's not the borrower that actually even has to pay that loan back whenever they leave the house. It's the house that has to pay that back. And so even in the underwriting process, very different than like a traditional mortgage that we're used to, where, the bank's underwriting your credit worthiness, your willingness and ability to repay that loan. We don't actually underwrite the borrower to pay that loan back, because the borrower actually doesn't have to. And that sounds a little almost like shady there, but it's true. It's the house that has to pay it back.
All right. You said age 62 or older. So that means that this is an age qualified program, like similar to withdrawing from retirement accounts. You can't do this until you're 62. And that's a federal rule. That just is what it is.
Correct. Yep. And that's for the FHA insured loan. And so just to even give a little bit of, context to that as well. So about 90% of the reverse mortgages that are originated right now are the FHA and insured variety. That's the HECM. It's actually called the HECM. The other 10% then are private label jumbo reverse mortgages. And so, and the reason I bring that up is because there are some states, so Arizona, the state that I'm in now, actually allows us to originate reverse mortgages, jumbo reverse mortgages at age 55 and older. But yes, for the FHA insured loan, it's age 62. And then the home value limit for the FHA insured loan this year, and it goes, it's indexed each year, is $970,800. So that it covers a lot of homes, under that amount.
Is that the same amount as the when to get the Fannie Freddie Mae mortgage? I forget what it's called.
No, it's for jumbos. Yeah, it's different. Yeah. So the mechanics are a little bit different on how that's calculated. But no, I mean, and it's really just the lending limit. So just a real quick example, let's just say somebody, based on their age and based on where interest rates are, let's just say they have access to 50% of their equity. So, I would say even a couple months ago, before the 10-year treasury started to rise, where, it's up around and above 3 right now, when it was a little bit lower, it was easy for me or safe for me to say, hey, if somebody's age 70, they have access to about 50%. And then as they get older, they have access to more. So very similar to like a uniform life table for IRA RMDs. FHA has its own life expectancy table just for the reverse mortgage for the HECM.
And the basics of it goes up because you are. Why does it go up again? Like, what's the basic thought about that? Like, how do you?
Just that. So that's a great question. And again, this is very fundamental to understanding it. So remember, this is FHA insured, but it's like, well, there isn't a payment. I mean, what is FHA actually even insuring when you really think about it, right? Why am I paying an insurance premium up front on this loan? What is FHA going to do for me? And so the reality is, because it is a negative amortizing loan, which means you don't have to make a payment. You do not have to make a monthly payment on this loan until the last borrower leaves the house. And so, let's just, simple example. Let's say there's a $600,000 home value. Let's just say they have access to $300,000. Let's say the interest rate is 5%. So we know that there's going to be $15,000 of interest that's going to be charged on a $300,000 loan, right? The borrower doesn't have to ever pay that. Yeah. And so that goes up to $315,000. The next year, it's going to be 5% on the $315,000. And so it's going to compound, and that's going to grow. And remember, the bank's actually loaning the borrower money. They might not ever see that money back for 20 or 30 years.
Yeah.
And so why would a bank even do that then, right? And that's kind of another question. It's like almost like, this sounds too good to be true. Well, it's because FHA is going to insure it. So even if, let's say, home values dropped, or just by virtue of the loan compounding for so long, or let's say somebody, kind of beat the bank theoretically and, lived even past age 100, and they beat the amortization table, that FHA is going to make up that difference to the lender. So let's say, again, that same couple, fast forward, they're 95, their loan balance is now, let's just call it 700,000. But let's say they put a big Walmart in behind the house, and now it's only worth 600,000, right? Well, who's going to make up that difference? They owe 700,000. The house is only worth 6. How does it? Well, that's where FHA comes in. The borrower, it's a non-recourse loan, legally non-recourse. The borrower never has to pay that. So FHA then pays that 100,000 to the lender.
So the earlier you get the reverse mortgage, the more compounding is going to happen. So the less amount they would offer you, right? That's kind of like the idea.
Yeah, the longer you have, obviously, the more time it has to compound. And FHA is trying to avoid having to pay that claim. So they don't ever want it to go underwater either. But again, it could happen, right? Either because, again, either somebody lives too long, or maybe property values didn't really keep up even with inflation.
I guess in the same token, like if interest rates go up, that means faster compounding. So then less amount right now.
Exactly. And so that's what, so to kind of circle back to, what I'd mentioned before, a couple months ago, I could comfortably say, hey, 70-year-old, kind of simple, back of the napkin math, 50% equity. Now that's probably closer to 45%. And so if you're 62, you might only be able to access like 35%. And that's something as well, people will come to me and they'll say, hey, my home's worth 700,000. It's paid off. We'd like to get all of it out. You can't, and then, I have to tell them, hey, it's really only a portion of it, because to your point exactly, Gabriel, the younger you are, the more time it has to compound, the more likelihood it could get underwater. And so, so the older you get, the more you have access to, just by virtue of having less years, likely in the home before it has to be repaid.
So to super simplify this, someone who is, let's stick with the FHA version, someone who's age 62 or older, who has equity in the home, who would like to tap that equity, like to access that for use, for actual spending, for actual cash. In a reverse mortgage scenario, they're able to get, it sounds like definitely a lump sum, or possibly even, can you do it as a payment stream, as an income stream? Can you turn this into kind of an annuity for them as well?
There's two primary ways to structure a reverse mortgage. And this is getting a little bit into the weeds with it, but this is really an important point. Because there's pros and cons to both, but there's essentially two forms. You have a fixed rate version and you have an adjustable rate version. And that's where, when people who aren't really sure what they're looking at, they're reading through it. It's just like, wait, what? It doesn't really make sense, because that's usually not delineated very well at the beginning of whatever they're reading. And they're fundamentally different in how they're structured. So, so just to kind of walk through that briefly. So the fixed rate loan, which, to anybody, that as the borrower, a fixed rate's a good thing, right? I mean, for the most part, you have certainty, exactly how much that loan is going to accrue every year. You can plan for it easily. You don't have stress. If interest rates are going up, you don't really care. Again, you have a good rate locked in. The flip side, though, is that isn't as good for the bank then, right? Because again, they're loaning you money in today's dollars. And if interest rates go up, a year later, they could have loaned that money out at a higher rate, right? And so because of that, the amount that somebody can access in a fixed rate mortgage is actually a little bit less than it is on the adjustable rate. And so that's a limitation as well. But so in the fixed rate loan, just to explain that, so that's a closed end loan as well, which means that whatever you want out of, or whatever you want from equity out of the house, you actually have to do at closing, and then you don't have access to it anymore. So there is no income stream, there's no line of credit. It's literally, that is actually just a lump sum. And I would say, that's probably more common for scenarios where somebody may even have an existing mortgage, because another important point is that the reverse mortgage has to be the first lien. So it has to pay off all the other mortgages, which is one of the most common reasons people do this, is to extinguish their forward mortgage. If they're like, hey, we're not going to pay this off anyway before we die, why are we even paying on it, right? Sort of that mindset. So if somebody has a larger balance to start with, they're probably a little bit more sensitive to interest rate, right? Because, they can see those numbers get bigger and compound. Whereas the adjustable rate loan, again, very different. That's actually an open-ended loan. And so again, pros and cons, the downside is that it's adjustable, right? So as interest rates are going up, that's going to accumulate at the current cost of money today, because on the adjustable rate loan last year, it was changed by FHA, but the only adjustable part of the adjustable rate is the 1-year CMT, or the constant maturity treasury. So it's like basically the 1-year treasury rate. And so as that goes up, then the interest rate's going to go up as well. But the great thing and the flexibility about this, and I would say about 85% of all the reverse mortgages that are originated are actually adjustable rate. So even though, they seem like they're at higher risk because of the rate, the benefits just really offset that. Because to your point, Robinson, you can access the, again, let's use that same example, $600,000 home. Let's just say they have access to $300,000, but they don't need the money right away. They can just set that up as a line of credit that they can tap into anytime later. They can do an income stream. They can manually take out what they want as they want it, or there's actually an option as well through the FHA insurance where they'll guarantee an income stream similar to like an income annuity, like a life income annuity. And then, then there's also a lump sum portion, or you can even do a hybrid of all that. Sometimes people might take a little bit out, a little lump sum, maybe buy a car, replace air conditioning, maybe, get a little bit of extra income, $200-300 a month, but then keep a couple $100,000 as a line of credit. The last thing I'll say just, briefly on that is that, the other sort of like the magic, and this is what a lot of people, kind of sell, I guess, in terms of the benefit of the reverse mortgage, is that on that line of credit, what's very unique about this, and some people look at it as still a loophole that might be closed one day, but that line of credit actually is going to grow. The unused line of credit is going to grow at the exact same rate as the balance. So let's just say, again, same example. Let's say the line of credit is, well, let's just say that, because of closing costs and what they took out, let's say the original loan balance is $50,000. And then that, their line of credit's $250,000. And so, and just for easy math, let's say the interest rate's 10%. So we know at the end of year one, the loan balance now is $55,000, right? The $5,000 on the 50, and then the 10%, would grow on the line of credit. So that would be $25,000 on the $250. So now after year one, their loan balance is $55,000. The line of credit's $275,000, and that line of credit's going to keep going up even if the property value dropped. It's guaranteed. It can never be revoked. It can never be canceled. It can never be reduced, which is completely opposite of a home equity line of credit that can't, all three of those things can happen. And so again, there are a lot of, then, from a planner standpoint, it's just like this blank canvas. You're saying, oh my gosh, there's so much utility to use this money. And, the other, I guess, advantage is that it's all income tax free because the IRS looks at it as proceeds of a loan.
Like that's just an immediately kind of complex and a little bit confusing point. So I can see why someone would get lost and be like, okay, wait, my balance is going up with this, but it's generally to people's advantage. I think as I think about this is a tool in the toolbox, right? If anyone planning, the trade-off, we just talked about a good bit of the benefits, right? We're talking tax-free income. We're talking a better alternative. We're talking federal insured so that the banks don't have to take risks. What you're really giving up here, and correct me if I'm wrong, I'm hearing that you're getting a bunch of benefits about tapping that home equity, but what you're giving up is functionally upside in the equity of your home. That's what you're trading off. You're saying, all right, if my home is worth $500,000 today, and I think it's going to be worth 10 million when I die, some crazy number, you're giving up that upside. You are sharing that with someone else, not just sharing it, you're selling it for an immediate benefit. And that's a good trade for a lot of people.
Yeah. So you're not selling the home. So the
you're not
homeowner
selling the home,
owns,
but you're still owning the home, but the future equity upside of the home, I should say, future price appreciation of your home is the trade-off, right? That's functionally what you're giving up economically, or no?
Yes. Well, from a technical standpoint, no.
Interesting.
You're still going to keep all your appreciation. Is there an interest cost you're incurring? Yes. So there's a net appreciation difference, yes, but you're not giving up the whole, and that is fundamental because the reality, it's a cost, right? But it's the same way, if and this is where you can get philosophical. That's why I like talking to planners about this, because it's fun to kind of go in circles and play these what ifs. But it's no different than taking money out of an IRA and looking at it from an investment standpoint, like a business does, as an opportunity cost. So if you take out $50,000 out of your IRA, you're also giving up whatever all that upside on that 50,000 over the next 30 years was, right? That's an opportunity cost. It actually is from an investment standpoint. Same thing with the reverse mortgage. You're taking 50,000 out of your home equity. And so, yeah, but the difference is that that's actually a known amount. And then again, it's either capped or it's either fixed. So you actually know exactly how much it's amortizing and how much it's accruing, or even if it's an adjustable rate, the other part that I left out just to, because there are a lot of variables, I try to simplify it. And just to your point as well, Robinson, on paper, clients have comparisons and amortization. So it's a lot easier to see this. We're not doing it all verbally like this. But let's just say you have an interest rate of 5% and the home appreciates at 6%. It's almost an arbitrage. I mean, yes, you're not having as much there, but then when you think about it, okay, so you're taking money out of the house, you're just using another part of another asset on the same side of the balance sheet. And then what the aha moment is that, and really, I'd say from a financial planning standpoint, the best way that it's used is to use it as a substitute for other things, right? So the 50,000 you take out of your home, yes, you're going to accrue interest on it, but that's 50,000 you didn't have to sell out of your portfolio. Especially if the portfolio is down. I mean, that's the fastest way to run that into the ground. Then you are forcing, you're getting yourself in a situation later when you deplete assets that, hey, we have no choice but to sell the house because we're almost out of money, right? And so it's to use it as a substitute, but the interest rate is actually capped as well. So even the adjustable rate, it doesn't go that high. So there's two options. You can do a 5% cap or a 10% cap. Right now, the 5% cap's all we're really doing. It's the only thing that's really competitive. So even then, if, let's say somebody got into an adjustable rate loan now, and let's say their starting rate was, 5%. Yes, that can go up to 10%, but that's only if the 1-year treasury goes up another 5%. And so if it's at, 2.5 right now, let's just call it 2, that means the 1-year treasury has to go up to 7 for your loan to be accruing at 10%. But if we know if the 1-year treasury, like a money market rate's at 7%, we know banks are, probably paying 7-8% on savings. CDs are probably paying 9-10%. And the actual mortgage rate is probably back to what it was in the early 80s, 12, 13, 14%. But you're actually under market rate. It's only accruing at 10%, right? And then again, you're using it as a substitute when you really model it out from a planning standpoint that you're not using these other assets. So you're able to make all of your assets a lot longer. And then if it is an adjustable rate, the other nice thing is that there's no, this was designed for a retiree. It was literally designed by experts, debated in Congress for years to design this to be really like the perfect home equity release product for U.S. seniors. And so, along the way, just because you use it, maybe now when the market's down, you say, hey, you know what? I usually take 50,000 out of my portfolio. I'm not going to take it now because, stocks and bonds are down this year. Normally I would have sold out of, which one was up. And this year, I don't want to sell low. We're going to use 50,000 of the house. And then, there's been a lot of academic research that's been done to show then that, by letting that portfolio come back, not selling low, when it does come back, it might be a year from now, it might be 10 years from now, just pay off the loan. There's no prepayment penalties either. So, pay off that 50,000 later. And then use it again if you want, and then pay it off later. I mean, it's an open-ended loan in a line of credit with no prepayment penalties.
I have two questions, and they're from different parts of what you were talking about. The first one is we talked about structuring as like kind of like a lump sum I take away or like a line of credit. But what happens when someone structures as an annuity, right? Can you do it like an annuity type of like I want to get like, let's say I'm entering into my retired age and I want to have like $4,000 a month, and you work out the numbers and make sense. But let's say interest rates vary. Does the amount I would get vary too?
No, that's all factored into that same present value and amortization table that FHA uses for their table. Yeah, and I would also say just one other thing I would even add to that. And again, I would say this to both of you as financial planners because you'll understand it better. But I actually, just to be honest, I mean, I actually cringe. I hear a lot of loan officers talk about the 10-year payment, which is TENURE. It's the tenure, for lifetime. That's what it's designed for. It's not an annuity, right? It's not. It is. It's not an insurance product in that regard or whatever. So I try to stay away from using the word annuity. But I would just say, guaranteed lifetime income stream, similar to an annuity.
Yeah. So you can do that on among the zillion options that we've already covered and like ways that you can flip this. Alternatively, you could do the fixed.
And then buy an annuity.
ACEM, and then go to an insurance company and shop the entire, the entire marketplace of annuities.
Yeah, but it's different. Remember the taxes. You have a tax issue there.
It's actually more of a compliance issue, but it's the right thought. So one of the reasons, this kind of gets back to the first question, why don't people like it? Well, a lot of it has to do as well is because advisors, financial advisors, firms, especially broker dealers, they don't even let their people talk about it. They don't let their advisors talk about it. Well, why is that? Is it because it's such a bad product? No. It makes it look like it's because it's a bad product, because it's like, well, if it was good, you'd be able to recommend it, right? But it's not because of that. It's because these broker dealers, they don't trust their advisors to not cross-sell. To tell a client, hey, take your money out of your home and let's drop it in this annuity where I can get a 4 or 5% commission. Because now think about it, you're paying an interest cost every year on that money. Now you're putting it in an annuity. And there's a built-in cost as well to that too, for the exact same benefit you would have gotten from the home. So yeah, so they actually do the exact same thing. And so that's actually, that would be, conceptually it's good. Theoretically, yes, somebody can do whatever they want with the money, but that's where I would say, hey, I'm not, even though I am a certified financial planner, I've done, I know financial planning, I know retirement very well. I know all the variables inside and out. I'm not a financial advisor right now. I'm not your financial advisor. I have to be very clear, but I highly recommend that you go talk to a financial advisor, if somebody was thinking that way.
I have my second question is, let's say, I get a reverse mortgage, and then my house, like we had like now, houses are up like 20, 30%. And let's say I passed away and my house is worth this amount, but then when we issued the reverse mortgage, we had planned it on this, like who gets that differential? The idea is that the house compounds at a much higher rate than the interest is.
Because it's a bigger number, starting bigger number. Yep. And that's the math of it. Yep.
So like at the end of the day, who gets that benefit, the extra compounding?
Oh, well, it's just like any other mortgage, right? So let's say somebody has...
The remaining, after you pay off the mortgage, if there's something remaining, it could go back to the heirs or something?
The estate.
100%.
Yeah, the title stays in the borrower's name, yeah.
Yeah, the reverse mortgage is just a lien. It's just a lien on the property, just like a mortgage or even like a mechanic's lien because you didn't pay, your repair bill or something, It's just a lien. That's all it is. And so yes, that has to be paid. But it's essentially when the last borrower on the loan or even the non-borrowing spouse who set up properly ahead of time is on the loan, when they leave the house, that's when that loan has to be paid. Again, only by the house itself. So again, same scenario, $600,000 house to start, $300,000 balance. Let's say they used it all, they accrued interest. And again, to your point, let's say, the home appreciates to $900,000. Now that loan balance is $600,000. Let's say that, the owners die, whoever is going to inherit the house or whoever is the executor or executrix of the estate is going to step in. They're going to, contact the servicer and they're going to decide what they want to do. And if they don't want the house, they're just going to sell the house like they would anyway. Right. And we know that, parents always, that's one of the big reasons that people also don't want to do this, because they're like, oh, I really want to leave the house to the kids. Well, this doesn't change that. This is just taking money from somewhere else on your balance sheet that might be a little bit more efficient. But there's that emotional component of the house and the home and what that represents that really clouds a lot of people's judgment, which is, also just, I can't help but to plug. That's also why I think that, like both of you are doing right now, really diving in, to really, understand even the concepts better, because it's financial planners that should be talking about reverse mortgages. I don't think it should be loan officers. I think it should be certified financial planners that are talking about reverse mortgages, because again, they know the context and they can really make sure that that's the better fit for a client. And so that's why I prefer to work with advisors. Again, I only do the loans. I don't do planning, but I want to make sure that these clients are, doing the right thing and it's being structured the right way.
Let's go real quickly into kind of the nuts and bolts of this. So if you've gotten this far, you've got an understanding of how this might work. Maybe it's for yourself. Maybe you're thinking about it for your parents. As a starting point, let's think about how to be a good reverse mortgage consumer, how to be a good shopper for it. So first of all, are there good calculators that you can use to get an idea of this? And then how do you find an honest broker who's going to do a good job? And how do you differentiate between all the people, can I just log on to the infomercials, like turn on my TV at 2 a.m.? Is that how I shop for this?
Understand I'm biased, right? I do. And again, that's part of my fiduciary duty. I have a conflict of interest with this answer. But I would also say that exact same question is partially what led me to this line of work as well, because I was in that scenario. I had to ask myself that same question when I had clients that I knew that the reverse mortgage was the actual answer. It was the answer. It's what they needed to do because they did not want to leave their house, but they just didn't have enough liquid assets to support them in the house anymore. Use your home to stay at home. That's, kind of FHA and the National Council on Aging, number one use of the reverse mortgage. So I was in the same boat as a financial planner, where I had to ask myself the same question. And what I had to do is just, I wasn't able to give names of people or companies. So I would just have to tell people, hey, reverse mortgage would be a good, looks like it would be a good thing for you. Go, Google reverse mortgage in your zip code and good luck. And when I actually had clients that were paying me as their sole primary trusted advisor, that didn't really sit well with me because I didn't know who I was sending them to, right?
No, nor with them, probably.
And I know, yeah. And so, or that, but the other thing is, a lot of people, they just really don't even include their advisor on a lot of these decisions. And even ironically, I found, and, I could get into some, research numbers. I have like data and statistics as well to support some of it. But most people, or a lot of people don't even tell their advisor they're doing it. Like, again, they kind of keep this in secret because it's like, they think it's like this dirty little secret, this like kind of, risky thing that they're doing that they're really not sure about. But yeah, so just like anything, it's just, you have to make sure that, Google, look for reviews, right? I think that's probably a good, just kind of general consumer advice. See if there's reviews on somebody. Look at what their credentials are. But at the end of the day, just like shopping for an advisor, right? You really do need to shop around and just make sure that it just feels right too, right? I've heard from advisors who've sent me clients, that, they had somebody that they were going to before, or one of their clients came to them to ask them if they knew of anybody because they didn't have a good experience, or they felt something sleazy, or it was just a little bit too salesy. And so, that does happen. And then, that also might be a reason that somebody doesn't do it, which again, kind of comes back to that initial point that I had that, I don't know if we've done a great job putting the right people out there in front of people to actually position it, because if it's not positioned well, or if somebody's, charging through the nose and makes it so expensive, well, yeah, of course it looks like a bad product, because it probably is at that point, but there likely could be a better way. The only other thing I would add to that is that, research does show as well, there's about 90% of people don't shop, even get a second quote for a reverse mortgage. So again, I look at that as, from a CFP standpoint, that's a huge consumer risk, right? So I highly recommend people to shop rates, especially if they don't feel like, they're getting the right thing.
There's surely a lot of regulation around this. Like, I've only gotten one mortgage in my life, and it was maybe the most papered transaction I've ever had. I have the records. I think it's 120 pages of scanned crap and notaries and this and that. But there was a pretty good summary page around costs, around what my mortgage originator was going to make, all the stuff that was getting rolled up in the loan. It's not I can't remember all the numbers, and it wasn't perfect, but there was a good bit of disclosure. Would you say that the reverse mortgage works a little bit similarly? Is there a good consolidated standardized disclosure for costs that people can look at?
Absolutely. Yep. And that's all stuff that's been hammered out the last, 12 years by FHA and HUD as well. One of the most fundamental safeguards and really speed bumps, I would even say, in the process as well, that was introduced, is that there's mandatory FHA counseling as well that every single borrower has to attend and get attested to before they can even apply for a reverse mortgage. It's like a 1-hour counseling, and that kind of leads into costs. So there's only really 2 out-of-pocket costs typically, and there's ways to there's one-offs, but just generally speaking, it's the counseling fee that needs to be paid out of pocket by the borrower, and then their appraisal typically that will have to be paid for. Other than that, everything else can be financed. But that counseling, most people, everybody that I've worked with, they've actually really liked it. I've told them, hey, go in, ask a bunch of questions, but that's their job. Is it the process is, let's say I talk to a borrower, we walk through, hey, is this even really viable for you? Is this really something? Is this something that could work for you? And at that point, I don't steer people. I don't even recommend anybody take on debt, but I'll just lay out the options and say, hey, you can do this, 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 and this. This is how it would work. These are the pros and cons to each one, and then let them choose if they want to move forward. Then at that point, in the proposal that I've given them, there's actually a code, and so there's it's like a 6 or 8 digit code that's in there, and it's tied into the FHA system. And so what they do then is then they'll take that proposal, they'll go schedule counseling on their own. We give them a list of possible counselors, and then they give that counselor that code, and that counselor can actually pull up my exact proposal for them. And then that's what their job is to basically just walk through all that, walk through the total cost of the loan, walk through the amortization table, walk through the comparisons, just to make sure that the borrowers are fully on board, that there hasn't been a stone unturned on what this is and everything. And so, at least for me, as you can tell, I'm pretty long-winded with things, and I probably over-disclose more than I have to. But for me, it has been a great thing because clients come back and they're like, Jason, they said exactly what you said, or they verified or validated everything you'd said. So it really makes them feel at ease then. So that's the number one safeguard. And then beyond that, to your point, it's a standardized loan, right? So the difference between a loan, a reverse mortgage with open mortgage, or any other HECM loan, it's the exact same loan, the exact same structure. The difference is going to be the service, the time that it takes to do it, the cost, and then, anything else that's, agreed upon in terms of service or availability later. From a financial planning standpoint, I think one of the best ways for a financial planner to understand really the function, like where does this thing fit, is looking at 2 consumers. Let's say you have 2 people, they're both age 62, they both did all the right things, they saved, they paid off all their bills, they had good credit, they put their kids through college, and now they're retired, and they're both worth $1.3 million, and they both are retiring at age 62. The difference is that just by virtue of the way that they lived, or they made consumer decisions earlier in their life, they have different asset structures. And so one borrower has a home that's worth $1 million, and they have a liquid portfolio of $300,000, no debt. The other borrower has a home worth $300,000, but a liquid value of $1 million. So again, they're both worth $1.3 million. One isn't any better than the other, but their advisors, let's just even use again a 5% withdrawal rate just for easy numbers. The person that has the $1 million house and the $300,000 portfolio, their advisor is telling them, hey, you can spend about $15,000, $20,000 a year, on top of everything else you have coming in, and which isn't really that much, right? That's less than $1,500 a year or a month. The other person, again, did the same things. They have a $300,000 house though, and their portfolio is $1 million. They're being told they can spend $50,000 a year. And so what the home equity conversion mortgage does is it equalizes those two. It allows that person that has larger equity to live like the person that had the $300,000 house, just by virtue of a product. You're just converting liquid asset into other. And so the way that I explain it is it's like a balance sheet equalizer in that regard. And that's how a lot of people need to look at it, because a lot of people do have very large home values. And, maybe they just put more, maybe they liked a bigger house. Maybe they had a lot more kids. Maybe, they had to have a bigger house. So again, it's not really their fault. And then, so the government designed this for those people as well to not have to sell their home just to be able to live in retirement, because what a terrible time to have to move if you don't want to move, right?
Couldn't agree more. That's a great place to end it, I think, and a great example of exactly where this fits in. Jason, hugely appreciate you, first of all, reaching out. You're a cold reach out with educational materials first. Keep on it. Keep spreading the good word. I'm sure we'll have you back if we need to get into this in more detail.